Hey, so right now, Nvidia's stock is caught in a tug of war. On one side, you have a massive anti-monopoly probe from China that's spooking the market. On the other, you have a quiet $6.3 billion deal that might be one of the most bullish signals I've seen all year. And depending on which rope you pull, you could either be protecting your capital or leaving a huge amount of money on the table. Look, if you don't have time to stick around for the whole breakdown, here's the one thing you need to understand. The China situation is most likely political theater, a strategic move in a much larger game. The real story, the one that tells you about the true underlying demand for AI, is buried in the fine print of a $6.3 billion deal. And that's what we're going to dissect today, along with the technical picture which fully supports the story that I'm going to explain later. For those of you who are new to the channel, my name is DataCat. I used to be a corporate analyst. I spent a long time inside one of those giant Fortune 50 companies, basically living in spreadsheets, trying to make sense of the numbers for people way up the food chain. I eventually traded that life for this, a keyboard, a laser pointer for my actual cat, and a chance to talk directly to you. I find it's a much better use of data. I'm not here to brag or sell you anything. My goal is just to share my research and hopefully help you see the market a little more clearly. If you find that valuable, maybe consider subscribing. It helps the channel, stay alive. Alright, so let's get into this. You have two huge conflicting pieces of news hitting Nvidia at the same time. First, China's market regulator has opened an anti-monopoly investigation. Now, whenever headlines flash words like China and investigation, the market reacts like a cat hearing a vacuum cleaner. It's immediate and it's fearful. The concern is that Beijing could slap Nvidia with massive fines. We're talking anywhere from 1 to 10% of their annual sales, or even forcing them to change how they do business over there. Then almost at the same time, details leak about this enormous deal with CoreWeave. It's a $6.3 billion arrangement where Nvidia is on the hook to buy any of CoreWeave's unsold computing power all the way out to the year 2032. So you have this powerful storm of geopolitical risk on one hand, and this signal of massive locked-in demand on the other. Let's break down the bull case first, the reasons why the current dip might be a buying opportunity. My take here is simple. The China probe is simply not a genuine long-term threat. It's a negotiating tactic. Think about it. China's own tech giants, companies like Tencent and ByteDance, are completely dependent on Nvidia's high-end chips for their own AI ambitions. For the time being, despite all the propagandas going on, I still haven't seen any domestic alternatives in China that even come close. So, for Beijing to truly cripple Nvidia's ability to operate would be a self-inflicted wound. It would be like declawing their own tech industry. The most probable outcome here isn't some catastrophic ban. It's a long, drawn-out negotiation that ends with a manageable fine, allowing everyone to save face while business continues. The second part of the bull case is the Federal Reserve. The market is widely expecting a 25 basis point rate cut. For a high-growth stock like Nvidia, lower interest rates are like rocket fuel. It makes their future earnings more valuable, and it pushes investors toward growth assets. If the Fed signals that more cuts could be coming, that sentiment alone could easily overpower the negative noise from the China story and kickstart a rally. And this brings us to the CoreWeave deal, which is a perfect example of the undeniable structural demand for Nvidia's hardware. A $6.3 billion commitment that extends for nearly a decade shows you that this AI build-out is a megatrend. It's not going to be stopped by short-term political drama. Now, for the bear case, which you should have heard countless times by now, allow me to reiterate once again briefly. The biggest one is simple: uncertainty. The market hates uncertainty more than a cat hates a closed door. It just can't stand not knowing what's on the other side. As long as this investigation is active, there's a ceiling on the stock. Big institutional funds might trim their positions or just wait on the sidelines, which could keep the price suppressed no matter what the Fed does. The other issue is valuation. Let's be honest, Nvidia has had a historic run. As I've always said, the stock is priced for perfection. When you're priced for perfection, any hiccup, like a major regulatory challenge in your second largest market, can trigger a wave of profit taking. The stock is simply vulnerable to bad news right now. And of course, the Fed could always disappoint. If they cut rates but use hawkish language, suggesting inflation is still a worry, and this is the last cut for a while, the whole market could sell off, and it would definitely drag Nvidia down with it. Okay, this brings us to the most important part of the story, the CoreWeave conundrum. This deal has become a sort of Rorschach test for investors. Some see a huge red flag, and others see a strategic masterstroke. The bearish view, the red flag interpretation, is rooted in one simple question. If demand for your chips is so insatiable, why do you need to guarantee anyone's sales? This view suggests that maybe, just maybe, the explosive growth is starting to slow down. The argument is that Nvidia has the best view of the entire AI supply chain, and they might be seeing early signs that supply could outpace demand down the road. So by guaranteeing CoreWeave sales, they're using their own financial muscle to pull demand forward, ensuring a key customer can keep buying, which keeps Nvidia's own growth narrative looking flawless. To a skeptic, it looks like they're underwriting their partner's risk because they aren't 100% sure all that new capacity will get filled on its own. Now for the other interpretation, the one that I believe is more accurate, signals a strategic masterstroke, and here's the logic. First, remember that Nvidia's biggest customers are the hyperscalers, Amazon, AWS, Microsoft Azure, Google Cloud. But these customers are also becoming Nvidia's biggest long-term competitors. They are all pouring billions into developing their own custom AI chips. CoreWeave, on the other hand, is different. They are a specialized cloud provider that is 100% aligned with Nvidia. They aren't a competitor, they are a partner. By backstopping them, Nvidia is creating a healthy ecosystem. It ensures a major independent player can thrive, which prevents the hyperscalers from cornering the market and gives customers more choice. It also protects Nvidia's own investment, since they own around 7% stake in CoreWeave. Ultimately, the bullish argument is that Nvidia has run the numbers and is so confident in long-term demand that the risk of having to pay for empty capacity is tiny. They see it as a low-risk move to lock in a loyal partner for the next decade. The $6.3 billion figure isn't a sign of fear, it's a testament to the sheer scale of the AI revolution. So, when you put the pieces together, the narrative becomes clearer. The political noise from China is likely temporary, while the fundamental demand story, evidenced by the CoreWeave deal, is long-term and structural. Now, let's look at what the charts are telling us, because the technicals add another layer to this whole story. They perfectly mirror the fundamental conflict we just talked about. If we look at the very short-term 1-hour chart, the picture is, well, it's a bit of a bruised battleground. The immediate trend is bearish. You can see this series of lower highs and lower lows, which shows clear selling pressure over the last few days. But there are signs that the sellers are getting tired. The stochastic indicator is showing we are deep in the oversold territory. This suggests a bounce could be coming soon. We're also seeing a small engulfing bullish candle in the last hour of trading, which is another little clue that buyers are trying to step in and set a floor. Now let's zoom out to the daily chart where the real story is. The most important thing to see here is how tight the Bollinger Bands are. Right now, the width of these bands is in the 5th percentile for the entire year. That is extremely compressed. Historically, when you see a volatility squeeze this tight, it's followed by a period of high volatility. The stock is a coiling spring. It is gathering energy for a very significant price move in the near future. And look where the price is. At $174.88, it's caught in a technical no man's land. It's just a hair below its 20-day EMA, which is at $175.26, and just a fraction of a penny above its 50-day SMA at $174.80. This is the very definition of a decision point. The way the price breaks from this tiny cluster of averages will likely tell us where it's headed next. But despite this recent pullback, the long-term health of the stock is undeniable. The price is still 24% above its 200-day moving average, and a golden cross has been active for 55 days. This tells us we are looking at a minor pullback within a major powerful uptrend. Coincidentally, the momentum has also completely reset. The daily RSI is at a perfectly neutral 50. This is constructive. It means the overbought conditions from the last rally have been completely worked off, giving the stock plenty of room to run in either direction. And finally, the selling on Tuesday lacks conviction. The relative volume on the last down day was low at just 0.7 compared to the 20-day average. This suggests the recent drop wasn't driven by panic or big institutions dumping their shares. It was more of a quiet drift lower, driven by that uncertainty we talked about. So, when you put it all together, the path of least resistance becomes clearer. The market is frozen, waiting for a catalyst from the Fed. In the immediate hours before that announcement, the most likely path is sideways, chopping around in a tight range between support at around $167 and resistance up near $180. But after the catalyst hits, that sideways path is over. The energy from this squeeze will be released. Now, I'm not your financial analyst. This is definitely not financial advice. Remember that I'm just a random guy hiding my face on YouTube. But the bullish scenario, which I believe has a higher probability, is that the Fed delivers the expected 25 basis point cut and uses dovish, reassuring language. This will be the spark that resolves the squeeze to the upside. The first target would be a break above the 20-day moving average and that $180 resistance level. The second target would be a retest of the recent highs around $184.50. The bearish scenario, which is less likely but still possible, is that the Fed is unexpectedly hawkish, or some genuinely bad news comes out of China. In that case, the squeeze resolves to the downside. The first target would be a decisive break below the 50-day moving average and key support at $166.74. From there, it could move toward the next major support zone near $164. So, my final verdict is this. A bullish bias is well supported here. The underlying long-term technical strength and the fundamental demand story are both incredibly strong. This recent pullback looks like a healthy consolidation. The stock is a coiled spring, and given the lack of panic selling, the path of least resistance following a neutral or positive catalyst is to the upside. If you found this breakdown useful and want to see more data-driven analysis without all the hype, consider subscribing to the channel. It's just me and my cat here, so every bit of support helps. Alright, that's all for today. DataCat out, stay safe and stay sharp out there.